In the early 2000s, America was booming. Houses were being bought and sold like hotcakes. Prices kept going up, and everyone, and I mean everyone, wanted a piece of the action. Banks were handing out home loans like candy at Halloween. Good credit? Here's a loan. Bad credit? Still fine. No job? No problem. Come on in. Now here's where it gets interesting. Normally, a bank gives you a loan and waits years to get its money back with interest. That's the old way, slow, boring. But Wall Street had a new idea. Imagine a bank sells your loan to a big financial firm. That firm bundles thousands of loans together into one giant package, like a mystery box filled with mortgages. Then they sell slices of that box to investors all around the world, pension funds, insurance companies, foreign banks. Everyone's buying these boxes because they're paying great returns. Everyone's happy. But here's the problem no one wanted to admit. Those mystery boxes, those beautiful, profitable packages, were worthless, or close to it. And the investors holding them, they were in serious trouble. Now here's where the dominoes really start falling. Lehman Brothers, one of the most powerful banks in the world, over 150 years old, they had loaded up on these mortgage packages, and on September 15, 2008, they filed for the largest bankruptcy in American history. The world froze. Stock markets around the globe started crashing. Banks stopped trusting each other. Credit dried up overnight. If banks won't lend to each other, they sure aren't lending to businesses. And if businesses can't borrow money, they can't pay employees. They start laying people off. Within months, the real world began to shatter. Over 8 million Americans lost their jobs. Families lost their homes. Retirement savings that took decades to build were wiped out in weeks. People who had done everything right, saved carefully, worked hard, played by the rules, found themselves standing in unemployment lines with nothing. The fear was everywhere. Real, raw, stomach-dropping fear. Turn on the news and it was panic. Open your bank statement and feel sick. Drive through your neighborhood and see foreclosure signs like some kind of nightmare you couldn't wake up from. This wasn't a number on a screen. This was a father telling his kids they had to move, a grandmother watching her retirement vanish, a small business owner shutting down a company she built from nothing. The US government had to act, and fast. The Federal Reserve slashed interest rates to almost zero. The government launched a massive $700 billion bailout program called TARP to rescue banks that were on the edge of total collapse. The phrase heard everywhere, too big to fail. The idea being, if these giants went down, they'd take the entire global economy with them. And slowly, painfully slowly, things started to stabilize. The banks were propped up. The markets started recovering. By 2010, America was technically out of recession, but for millions of ordinary people, the damage lasted years. Some never fully recovered. So what did we actually learn? We learned that when greed replaces responsibility, everyone pays the price. Not the bankers who created the mess, not always the executives who took massive bonuses while the system burned. More often, it was regular people, the ones at the bottom of the chain who paid the heaviest price. We also learned that our financial system is deeply, dangerously connected. A bad mortgage in Ohio can crash a bank in Germany. A greedy decision in a boardroom can end up costing a teacher her retirement in Tokyo. And here's the uncomfortable truth that still matters today. The conditions that caused 2008, unchecked greed, weak oversight, and financial products no one fully understood, those forces never fully went away. They just changed shape. The 2008 crisis wasn't just a historical event. It was a warning, one we can't afford to forget.